NFTs are back in the headlines today. Welcome to the Daily Forkast June 21st, 2022. I'm Megha Chaddah of Forecast, covering all things blockchain. We are taking a deep dive into combating NFT fraud after a Hong Kong star denies any involvement with one platform and Wechat bans another. We've got all that plus Babel Finance's debt agreement and job cuts at Bybit coming up. Let's get you up to speed from Asia to the world.
Join thousands of NFT traders who already start their day on CryptoSlam.
Let's kick off with dodgy dealings in the NFT space. First up, Hong Kong movie star Louis Koo has denied working with the Chinese NFT marketplace. Koo's agency Master Kingdom said Leon Wan showed a poster image for his 2021 crime thriller G-Storm and claimed that it was working with the actor. Master Kingdom denied that, saying it will take legal action against any misleading activity in Koo's name. Last Saturday, the company behind the marketplace claimed the images were authorized by a company called Anjung Lianmei Cultural and Creative. But on the same day, the film's production company and its mainland China distributor jointly issued a statement saying no such permission had been given. Meanwhile, Chinese social media and instant payment platform Wechat has banned an account for flipping NFTs. The NFT marketplace, which offers digital collectibles, features high-end tea products, is simply called NFT. Wechat banned the account for business activities related to the secondary trading of digital collectibles or cryptocurrency. The phrase digital collectibles is used in China after state media denounced speculative activities surrounding NFTs. Official accounts on Wechat are subject to disciplinary action or even a permanent ban if they are found to be involved in flipping collectibles. Staying on that theme, with a $12 billion market cap, the NFT space is huge. And while sales have cooled recently, unfortunately there are still bad actors at play. Forecast Lachlan Keller takes a look at how the industry is moving to fight fraud.
Hollywood funny man Seth Green's recent loss of 4 NFTs in a phishing scam is just one example of what can happen if you aren't careful. The market has also been hurt by insider trading, with former OpenSea employee Nat Chastain charged with wire fraud and money laundering by the US Department of Justice. Chastain allegedly exploited knowledge on which NFTs were going to be featured on OpenSea's homepage, helping to net 2 to 5 times their original value. So what's been done to combat problems like these? One legal expert based in Australia says existing laws can help.
We already have very robust consumer protection laws prohibiting misleading and deceptive conduct and unconscionable conduct during the operation of a business, and there's no reason why those shouldn't apply and be enforced in relation to NFTs as well.
Meanwhile, Sean Leong of law firm Withers Cattawong in Singapore says more regulation is coming.
I think we are transiting from a dominantly unregulated buyers beware framework to a legalized framework where digital assets are properly categorized, properly placed into legal categories, where the legal consequences, the legal requirements are made very transparent.
However, Leong warns that for the moment, legal adjudication could be complicated by the crypto community's strong privacy ethos, which can help obscure the identity of users. Yehuda Petscher of NFT data aggregator CryptoSlam told Forecast, fraud has gone on for too long, and the time has come for the industry to admit it can't manage the problem alone.
It's time to clean it up. It's something I was always hoping that the space would be able to police itself, and we wouldn't need lawyers involved in regulations and all those things, but we do. We really do.
Despite the headlines, it remains important to keep things in perspective. According to blockchain analytics company Chainalysis, fraudulent transaction activity last year fell to an all-time low in terms of the share of total crypto transaction volume. For Forecast, I'm Lachlan Keller.
Now let's round up what else you need to know from around Asia. Hong Kong-based Babel Finance has reached preliminary agreements on debt repayments to counterparties following a redemption and withdrawal freeze last week. In a statement, the crypto lender said the move has eased the company's short-term liquidity pressure. Meanwhile, the crypto crash is causing more job losses. In response to a report saying that the Dubai-based crypto derivatives exchange Bybit will cut up to 30% of its staff to reduce costs, A company spokesperson told FORKAST it wasn't an easy decision to make. The spokesperson added that affected employees will be given a severance package and access to Bybit's employee career support in their job transition. Bybit's job cuts add to a growing list of crypto firms including Coinbase, Gemini and Crypto.com that are scaling down staff numbers during turbulent economic conditions and declining cryptocurrency prices. You can find those stories and more at FORKAST.NEWS. Crypto markets continue to unravel under pressure from worsening economic conditions globally as well as central bank moves. Is there more pain ahead for crypto participants? Benjamin Stanley of Matrixport joins in to talk about how to navigate these choppy times. Benjamin, thanks for being here.
Thanks for having me back.
Now, major cryptocurrencies are trading at levels last seen in 2020, and per Fidelity's director of global macros, the OG of the crypto world, Bitcoin, is undervalued and oversold. Would you agree?
Yes, so what we've seen over the last couple of days is that crypto markets have been under immense couple of pressure, just like any other risk assets. Tighter monetary policy around the world is creating a really difficult backdrop. The Fed's 75 basis point hike, the first time they've done this in over 25 years, and them continuing to remain hawkish, certainly impacting our asset class. Now, if you combine that with issues in the crypto space where major institutions are experiencing stress and a liquidity crunch, and voila, you get that heavy selling pressure. In fact, Bitcoin retrieved back to and even broke 200-day moving averages, as well as the peak of the last cycle. Both were considered very strong resistance levels. If we're looking at fundamentals though, if you look at the number of BTC addresses holding meaningful assets, that's an all-time high. Hash rate is at record high, and so is lightning capacity. So to answer your question, most metrics, BTC looks oversold, while the fundamentals remain robust. That, however, doesn't mean that we can't go any lower from here, because what's driving prices now is forced selling and liquidation. So what I would recommend is being nimble here. Don't use leverage and just stick to your dollar cost averaging strategy.
We have seen pressure build up on the institutional side with high-profile margin calls coming in, even as MicroStrategy CEO said they have enough collateral to pledge on a Bitcoin loan. What do you make of the long positions being liquidated?
Forced selling is one of the main reasons that it's driving us lower. And it becomes self-reinforcing the lower prices go. That creates more selling pressure and extends onto borrowers that use crypto as collateral. Why is that so dangerous? Because even if one person blows up, that has this cascading liquidity effect. Now, MicroStrategy, I believe, they said their liquidation price is as low as somewhere in the 3,000 to 4,000 range of Bitcoin. That means we're still quite a bit away from them being liquidated. But many other major players are more risky. Celsius has been the most high-profile one, and we can actually see on-chain their Megha Chaddah loan where they deposited rep BTC as collateral. Their liquidation price there is around 13K now. And I believe many smaller players out there are much worse off than them. So while we don't know who's insolvent yet, that has led to liquidity drying up in a similar fashion like in the 2008 global financial crisis, where banks had stopped lending to each other because nobody knew who still sold them.
Well, leverage and derivative products are often considered signs of a maturing market. But in case of crypto, could these products be its underway?
I think our industry is still very early in the stages of financialization, and it's true that the financial unwind of over-leverage is exacerbating the current downswing. But I would argue this is actually more due to weaker risk management by some players than a flaw in the system. Lending under-collateralized or uncollateralized is a very risky business, and we're painfully getting reminded of that now. What we do know is that crypto is probably one of the last true free markets, and on-chain data can actually allow us better transparency in terms of assessing financial risk. And I firmly believe that the development of more sophisticated financial products, especially derivatives, is not just inevitable, but is ultimately a positive trend, because these products ultimately can help us reduce volatility in the long run and lower volatility is a prerequisite for further mainstream adoption.
Benjamin, thank you so much for joining in with your perspective as always.
Thank you.
And that's your daily forecast from Asia to the world. Follow us on Twitter for the latest updates at FORKAST_NEWS. Head to our website as well for more detail on all of today's stories and a whole lot more. Until next time, I'm Forecast Megha Chaddah.